What if one American number could move your stock, your gold, and your rupee all at once? Every time you hear US bond yields rose today, and you see the stock market fall or gold prices move or the rupee weaken, have you wondered why one number in the American bond market can shake markets in Mumbai, Tokyo, and everywhere else? That one number, the bond yield, is arguably the most important number in global finance. More important than the stock index. More important than GDP headlines. Today we're going to break down exactly what a bond yield is, why it moves opposite to bond price, how it connects to stocks, gold, and commodities, and how a market cycle framework from legendary analyst Martin Pring explains the entire sequence. No jargon left unexplained. Let's begin. Let's strip away the finance speak. A bond is simply a loan. When a government, say the US government, needs money, it doesn't ask a bank. It asks the public. It issues a bond, which is really just an IOU. You give the government, say, 1,000 Indian rupees, or $1,000 today. In return, the government promises two things. 1. It will pay you a fixed interest every year, called the coupon. 2. On a fixed future date called maturity, it will return your original 1,000 Indian rupees or $1,000, called the face value or par value. So if you buy a 10-year US Treasury bond with a face value of $1,000 and a coupon of 5%, you get $50 every year for 10 years, and then your $1,000 back at the end. Simple enough. Now here's where it gets interesting, because bonds don't just sit still after they're issued. They trade. People buy and sell them every single day, just like stocks. And the moment they start trading, their price can move away from that original $1,000. That's where bond yield comes in. Bond yield is simply the return you actually earn if you buy the bond today, at whatever price it's trading, instead of at its original face value. The simplest version is called current yield. Let's use our example. Face value $1,000, coupon $50 a year, so the coupon rate is 5%. Now let's understand three distinct cases of return to understand better. Case A, the bond trades exactly at $1,000. Yield equals $50 divided by $1,000 equals 5%. Simple, yield equals coupon rate. Case B, now say interest rates in the economy go up, and this old 5% bond becomes less attractive. Nobody wants to pay full price for it anymore. Its market price falls to $900. Yield equals $50 divided by $900 equals 5.56%. The yield went up even though the coupon dollar amount never changed. Case C. Say the economy gets nervous, everyone rushes to buy safe government bonds, demand pushes the price up to $1,100. Yield equals $50 divided by $1,100 equals 4.55%. The yield went down. This is the single most important relationship in this entire video, so let's say it plainly. They move in exactly opposite directions, always. It's not a theory, it's arithmetic, because yield is calculated by dividing a fixed coupon by a changing price. Professionals usually track yield to maturity, which also factors in the gain or loss you'd make from buying below or above face value and holding to maturity, but the inverse price-yield relationship holds true in both measures. Here's the intuitive version. Think of a bond's fixed $50 a year payment as a fixed-size pizza. If more people want a slice of that same pizza, they bid the price up, but the value per rupee spent naturally goes down, because you're paying more for the same fixed slice. That's a falling yield. If fewer people want it, the price drops, but now that same fixed $50 slice looks more attractive relative to what you paid. That's a rising yield. Now let's connect this to the stock market, the part most viewers actually care about. Stocks are valued, in theory, by discounting a company's future profits back to today's value. When bond yields rise, that discount rate rises for stocks too, which mathematically lowers the present value of future company earnings. That tends to pressure stock prices, especially high-growth, high-valuation stocks, whose profits are expected many years in the future. Real example. Through 2022, the US 10-year Treasury yield rose from around 1.5% to over 4% as the Federal Reserve aggressively raised interest rates to fight inflation. During that same period, the S&P 500 fell nearly 20%, and Nifty 50 in India also went through a sharp correction, particularly hitting high-valuation IT and growth stocks hardest, because their future profits, discounted at a much higher rate, were suddenly worth less today. There's also a more direct, simpler channel. Bonds and stocks compete for the same investor money. If a safe US government bond suddenly yields 5% with zero risk, some money that would have chased riskier stocks moves into bonds instead. That's often called the Tina versus Tara shift. There is no alternative to stocks versus there are reasonable alternatives once bond yields are attractive. Important nuance: this relationship isn't a rigid law. When yields rise because the economy is genuinely growing faster, not because of fear or inflation panic, stocks can rise alongside yields for a while. The relationship is strongest and most reliable when yields rise sharply and suddenly. This is where most retail investors get confused, so let's slow down. Gold pays you no interest and no dividend. Its opportunity cost is what you give up by holding gold instead of a yield-bearing bond. That opportunity cost is best measured not by the plain bond yield, but by the real yield. When real yields rise, meaning bonds are paying you a solid return even after inflation, gold becomes less attractive, because you're earning nothing extra by holding it while a bond pays you a real, inflation-beating return. Historically, gold and real yields move strongly inversely. Real example: in 2020, during the pandemic, US real yields turned deeply negative. Investors were effectively being paid to hold bonds, they were losing purchasing power in real terms. Gold rallied to record highs above $2,000 an ounce in that environment. Conversely, in 2022, as the Fed hiked rates aggressively and real yields turned positive again, gold's rally stalled even though inflation was still elevated. Broader commodities, oil, industrial metals, agricultural goods, have a slightly different relationship. They tend to track the stage of the economic cycle more than yields directly. Rising yields early in an economic expansion often coincide with rising commodity demand growth story, but rising yields late in a cycle, driven by a central bank fighting inflation, tend to eventually choke off demand and pressure commodities. This cycle stage idea brings us to the heart of today's video, a framework that ties bonds, stocks, and commodities together in one sequence. Martin Pring, a widely respected technical analyst, mapped out how bonds, stocks, and commodities move through a repeating six-stage business cycle. The key insight: these three asset classes don't peak or bottom at the same time, they move in a predictable sequence, because each responds to interest rates and economic activity at a different speed. Here's the sequence, stage by stage. Stage 1, bonds bottom, while stocks and commodities are still falling. The economy is weak, growth is slowing sharply. Central banks start cutting rates, or the market anticipates cuts. Bond prices start rising, meaning yields start falling first, because bonds respond fastest to expectations of easier monetary policy. Stocks and commodities are still under pressure at this point. Stage 2, stocks bottom, while bonds keep rising and commodities keep falling. As falling bond yields start to work their way through the economy, investors begin anticipating a future recovery. Equity markets bottom out and start climbing, even though the economic news is still bad, because markets are forward-looking. Stage 3, bonds peak, while stocks and commodities continue rising. The economy starts genuinely recovering. Growth expectations pick up, and bond prices peak, yields start bottoming out and turning up, as investors expect the central bank to eventually stop cutting or start hiking. Stocks continue rallying on improving fundamentals. Commodities finally bottom and start turning up too, as real demand returns. Stage 4, all three bonds, stocks, and commodities rise together. This is the sweet spot of the cycle. Growth is solid, inflation is still manageable, and confidence is broad-based across every asset class. Stage 5, stocks peak while bonds are falling, yields rising, and commodities still rising. The economy is now running hot. Inflation starts becoming a concern, central banks are hiking or signaling hikes, bond yields rise sharply, bond prices fall. Equity markets, sensing tighter money ahead, peak and start to roll over, even though commodity prices, driven by strong real demand, keep climbing. Stage 6, commodities peak while bonds and stocks are both falling. Finally, high interest rates catch up with the real economy. Demand slows, commodities peak and start falling. By this point, both bonds and stocks have already been falling for a while. Eventually, this exhaustion sets up the conditions for stage 1 again. Bonds bottom first, and the cycle repeats. The single biggest takeaway from Pring's framework: bonds lead, stocks follow, commodities lag. If you can read where bond yields are in their cycle, you have an early signal for where equities and commodities are likely headed next. Applying it in the real world, many analysts pointed to 2020 to 2021 as stages 1 to 2, bond yields near historic lows, equities like Nifty and S&P 500 recovering sharply off pandemic lows well before the real economy fully healed. Then 2022 resembled stage 5 moving into stage 6, yields rising fast on inflation fears, equities peaking and correcting, while commodities like crude oil stayed elevated for longer, before eventually cooling in 2023. Since so much of this framework centers on the US bond market, it's worth understanding who's actually behind the scenes. The Federal Reserve, America's central bank, doesn't directly set long-term bond yields, but it sets the short-term federal funds rate through its policymaking body, the FOMC, the Federal Open Market Committee. This short-term rate heavily influences the entire yield curve, including the closely watched 10-year Treasury yield. The U.S. Department of the Treasury is the one that actually issues these bonds: Treasury bills for short-term, Treasury notes for medium-term, and Treasury bonds for long-term borrowing, to fund government spending. How much debt the Treasury issues also affects bond supply, and therefore price and yield. The Securities and Exchange Commission, the SEC, regulates the broader securities markets in the U.S., including disclosure and trading conduct, though it's the Fed and Treasury that are the primary direct drivers of yield movements themselves. Together, these institutions make U.S. Treasury yields the risk-free benchmark that the entire world prices other assets against, which brings us to our final and most globally relevant section. Why does an American bond yield move Indian or Japanese markets at all? We have to understand these three main channels to get the answer. Channel 1. Capital flows and FII money. When U.S. Treasury yields rise, global investors, including foreign institutional investors, or FIIs, who invest heavily in Indian markets, can earn a safe, dollar-denominated return without taking India-specific risk. This can pull money out of emerging markets like India and back into U.S. bonds, putting pressure on Nifty and the rupee. We saw this clearly in 2022 and again in 2023, when rising U.S. yields coincided with sustained FII outflows from Indian equities and a weaker rupee against the dollar. Channel 2, the currency channel. Higher U.S. yields typically strengthen the U.S. dollar, since global capital chases the better return. A stronger dollar generally means a weaker rupee and a weaker yen. A weaker rupee makes imports, especially crude oil, which India imports heavily, more expensive, which can worsen inflation domestically and constrain the RBI's own room to cut rates. Channel 3, the policy channel, especially Japan. Japan is a special case because the Bank of Japan (BOJ) kept interest rates near zero or negative for years while the Fed hiked aggressively. This created what's called the yen carry trade. Investors borrow cheaply in yen and invest in higher-yielding U.S. assets. When U.S. yields are high and stable, this trade is profitable and widely used. But if U.S. yields fall sharply or the BOJ unexpectedly raises its own rates, as it did in 2024, this trade can rapidly unwind, forcing a rush to buy back yen and sell other assets, which can trigger sharp, fast volatility not just in Japan's Nikkei, but in global markets including India, as seen in the sharp global sell-off of August 2024. In short, U.S. bond yields function almost like a global risk thermostat. When they rise quickly, capital tends to retreat toward the U.S., tightening financial conditions everywhere else, including in India and Japan. When they fall, that capital tends to flow back out in search of higher returns, often benefiting emerging markets like India. Let's bring it all together in one line each. Bond price and bond yield move in opposite directions, that's mechanical, not opinion. Rising yields generally pressure equity valuations by raising the discount rate applied to future profits. Rising real yields generally pressure gold, since they raise the opportunity cost of holding a non-yielding asset. Martin Pring's 6 stages show us that bonds typically lead, stocks follow and commodities lag, across every full business cycle. The Fed, the Treasury and the FONC set the stage domestically in the US, but through capital flows, currency effects and carry trades, that stage effectively gets set for the entire world, including India's Nifty and Japan's Nikkei. If this made bond yields click for you, hit subscribe. On to Tiksha, we break down the numbers that actually move your money. See you in the next one.